6th of October. What we're going to do with the briefing this morning, I'm going to give you a bit of an update as to where we stand at the moment, some of the overnight news flow and yesterday's price action, and then Will's actually going to jump on and talk through crude in particular, given the fact that in the futures we did get very close towards touching the $50 handle yesterday evening, just prior to the NYMEX pit close. I think we topped out at around 49.97. So we've been on a pretty nice upward trend of late in crude, but I'll leave that for Will to paint the picture with the reasoning behind that move. One thing is we had a seminar with some external guests come in yesterday, and I overheard a conversation actually Will was having with one of the guys about part of the thing about trading successfully in the long term is kind of knowing which asset to trade at what period of time. And I think that's very prevalent in these current market conditions because, two real graphs, let me just show you really. Three major assets. Firstly, I've got these on 90-minute candles.
Share again the link.
And I've got the S&P on the top, and I've got treasuries at the bottom. I'm looking over the same time frames, and what's been quite clear to me when around economic data, just around the general market news that we've been having, is that there seems to be quite a clear trend in terms of US yields rising. Obviously the price and expectation, which we'll get onto shortly, of the market expectations of a 25 basis point hike upcoming in December continues to be cemented or built in. Even November increasing over 20%. And treasuries have fallen in a pretty steady fashion. However, equities in the S&P have been a bit all over the place. And it's kind of the reaction, I think, with equities is a bit of a stuck between how do we take this data? Do we take it as positive? The underlying economy is going to be able to cope with an interest rate rise, and therefore net good data is good for equities? Or is it the opposite? And that if it's too good, like the ISM non-manufacturing yesterday, actually, does that make me a bit nervous that potentially it might be a little bit more aggressive with the hikes? And so that's what makes it a little bit more difficult to play in the equity space. And sometimes you do get this. It's not always a clear-cut correlation. But what you're seeing in treasuries is certainly people are starting to buy into the fact that we've had a bit of a hawkish turn. In economic data, in central bank speak, in hawkish ECB source comments, hawkish comments from UK PM yesterday, there's a bit of a sea change really in direction from where we were a couple of months ago, and you're starting to see that play out on a direction basis, at least at the moment, in the likes of treasuries. And of course the other big one that fits with that more hawkish tone is gold. Now you look at gold, obviously we had that big run lower at the beginning of the week, that psychological breaking of that 1300 handle, which of course was also technically significant both pre and post Brexit. We've kind of consolidated slightly here. But downside, I did see there's a commodity strategist at Deutsche. I didn't catch what time frame he's looking at, but he's anticipating a 20 to 22% fall for gold from here on out. I would say that's at the more aggressive end of market calls. Again, I'm still more of the belief that 1250 is possible, but 1200, which is kind of the next technically significant big level, and psychologically, looks a bit of a stretch with the political risk on the horizon, for my own view. So the point being is, when we do get these economic data points, and obviously there's not too much today, but you've got the big one, non-farms, tomorrow, it is a case of picking your battles and knowing which asset is going to be potentially provide you with a better opportunity to trade. And in a nutshell, what I'm saying is that equities might not be that one at this present point. The dollar's been quite reactive in the FX market. The only problem is, if you look at euro dollar, you've kind of got catalysts to strengthen the dollar, but then obviously we had that big up candle in euro dollar after that surge in the euro on the back of the ECB sources talking about a 10 billion euro taper is being contemplated. Obviously also a very hawkish turn. So that's been counterbalancing, I would say, that surprise move in that direction of policy potentially for the ECB to the strengthening of the overall dollar. So maybe not so clear cut in the euro dollar pair, but again, it's about knowing which asset to look at or pair in the currency market. Certainly that's not been the case in cable, which has had quite a nice downward trend after the big level that was that 128.06 was that futures Brexit low that we had when that got taken out. It's kind of, now that we're below that level, I think that's kind of the upside cap, that 128 now going forward, because the fundamentals certainly are more bearishly aligned for the UK, because despite the data, it's the hard Brexit risk going forward and the overall outlook of potential deterioration in UK data as the timeline progresses, given the kind of artificial support at present from the weaker pound, which we've discussed before. So a couple of other things then just to quickly look at. And first off was this number we had yesterday, the ISM non-manufacturing PMI. I mean, what an outstanding recovery in that data set. And as I was pointing out yesterday, I felt that this would be ultimately more important from a market moving point of view than ADP, because ADP has been a fairly consistent data set. Variation has been minimal, certainly over the last 3 to 4 months. Whereas ISM, we had this disaster reading which led to September hike being taken off the table at the time. But we absolutely blew the forecasts out the water yesterday, 57.1. After slumping to a 6.5-year low in August, the September reading came out higher since October of 2015. What this means then, it just goes to show that it's getting harder and harder really for the Fed to delay the inevitable, because they're running out of excuses, so to speak. Now, I do feel though that there's always an excuse there if Yellen needs it, and the FOMC. They've only got to look externally. If you look back to the beginning of the year, that was obviously Brexit and China was the reasoning that they were suggesting why that they couldn't hike at that time. Just because US data is strong, that doesn't necessarily 100% mean that they'll hike, but certainly it starts to push them towards that direction. I just thought I would actually, I've just quickly knocked up this slide this morning because I wanted to show you the recent data, and these are the sorts of things which market participants will look at in the run-up to non-farms tomorrow. You've got the ISM non-manufacturing, we've just discussed that. We've also had the manufacturing side, which also has bounced back in expansionary territory, of course, and a decent lift from the depressed number, which shackled the Fed in September. ADP employment change was a touch below expectations, but you saw the market reaction yesterday. I mean, in terms of the variation of ADP against expectation, I would say that was broadly in line, really. And the other one that's really surprising is consumer confidence. You can see just about on my screen, the bottom right. And if you look at that, we are now just peaking above the highs that we had in around 2014, 2015. And in fact, consumer confidence in the US is riding at its highest level to pre the financial crisis. So obviously the outlook of the consumer is important, forward-looking, to grease the wheels of spending in the US, to get the economy going. The employment situation has been fairly consistent from a jobless claims perspective from non-farms. I mean, even though we had a slightly lower print last time, the 3-month average is still tracking at over 240. Manufacturing, non-manufacturing have both bounced back. This is why you're getting these moves at the moment in US yields, in gold, and ultimately what that's leading to is this chart. which is the Federal Funds Futures implied probability of a rate hike occurring. And as you can see, we are now up at 65%. And as a consequence, you can see then that the developed sovereign bond index has declined quite substantially. So not just T-notes, the overall market is paying heed to the fact that the expectation is that the Fed are going to hike at this point. Okay, just to finish off my side before I hand over to Will then, a quick look at the calendar today. My only advice would be there is a potential things could be fairly quiet because we're heading into the main jobs report on Friday, and the calendar is pretty bare of major economic events. Challenge of job cuts is really tier 3, I would say, on the data importance factor. The ECB minutes are always a bit of a non-event, given Draghi has a press conference post every meeting. Initial jobless claims, even if they're out of line, this will not be included in terms of how the surveys and the data is compiled for non-farm payrolls. The cutoff has already been, and so irrespective of how this jobless claims number comes out, it will not be included in the non-farms reading we'll get tomorrow. So that's going to lessen the impact. You've got Draghi speaking later. There's no set time as yet. G20 finance ministers and central bank governors meeting in Washington DC, always worth just keeping a half an ear out on the squawk. We have had factory orders this morning, so I mean, looking at the DAX, we are marginally positive. Of course, we had the higher close on Wall Street following that good data yesterday from the States. We also had higher or firmer energy prices, so that higher close in the US, positive trade overnight in Asia. The DAX a bit choppy this morning, albeit positive. Oil's a little bit of a pullback from that close to 50 high. German factory orders were actually slightly better than expected. It was the second straight month of growth and the highest reading since March. Now, if you remember me, I've been talking, or if you remember what I've been saying, German data has been pretty weak of late, so that's quite a positive sign. And just to finish off, Deutsche Bank, couple of news items just to be aware of. One of the more funny ones was that the US Justice Department officials are working on a mortgage securities investigation of Deutsche Bank and expecting the bank to settle the matter for 2 to 3 billion, according to people familiar with the matter. What a steep climb from 14 billion. Why on earth the regulators, well, I understand from their point of view they want to send a message to the banking sector, but obviously the ramifications on the market were pretty severe at the time. Deutsche Bank sources separately have also suggested the German government have been pursuing talks with the US Department of Justice to aid the company to secure a quick agreement regarding the fine for the sale of toxic mortgage bonds. So for now, it seems as though that ship has sailed and Deutsche has averted that storm. But these things can change quickly. Okay, guys, I'm going to hand you over to Will. He's going to talk to you specifically about energy, but have a good day.
Hello everybody, thank you very much indeed, Ant. Excellent preview. So I just wanted to talk about oil in a bit more detail. If you have been asking about oil today, and it certainly looks like something has changed significantly in oil. I was having a discussion with the Month 2 group, and they were saying, well, look at this rally we've seen in oil ever since Wednesday, 28th of September. We've moved from $45 all the way to $50. Is this really justifiable given that nothing has actually happened? Well, I think the answer to that is yes, because what we saw back in 2014, if I just go to a longer term chart, the biggest move that we saw back in 2014, one moment, was in November when OPEC made the announcement that they would allow free market forces here. Can you see this period here in 2014? This was OPEC making the announcement in November that they would allow free market forces to dictate the oil price, and they would no longer be intervening in terms of the supply level. So that was where it stood. Now, what we saw last Wednesday was a reversal of that, with Saudi Arabia coming forward with actual numbers And those numbers are a reduction to 32.5 to 33 million, and numbers for a cut, so actually going against their free market plans. So, this statement alone is the Saudis putting their hands up and saying, right, it doesn't work, our free market force approach does not work, and we will now start entering into much more active supply control. So that's why we're seeing this move, not because anything has happened yet. And in fact, conversely, you might have the opposite, because these cuts don't begin till November. So what you could, of course, have in October and the beginning of November, what you could have is oil producers ramping up to supply as much as they can to try and take advantage of this oil price, this new higher oil price, before the cuts come in place. So actually, it could be the opposite that happens. But the reason for this over 10% move is there's been a shift in rhetoric from Saudi Arabia. Listen, the next meeting is on October the 8th. Sorry, that's just coming up, really. October the 8th to 13th, there's an informal meeting. Sorry, November the 8th to the 13th, that's the informal meeting in Istanbul. Sorry, not October. That would be odd. Yeah, so the meeting's in Istanbul, 8th to 13th of October. I'm now going to be interested to see whether something actually gets applied, because what's surprising about this cut proposal is it's the Saudis that will be taking the vast majority of the hit, giving up their market share to other OPEC members. Now, we've never really seen them be able to do that. So a very famous English phrase is the proof is in the pudding. And I think that's what we have to see on November the 8th to the 13th in Istanbul. We have to see how does action actually get applied, what is actually being implemented to limit supply, and if it's nothing, if there's no traction, then yeah, absolutely, oil should come back into the low 40s. The fact that the Saudis are proposing that they're willing to give up such a market share, to me, also highlights just how much they must be hurting. It is them giving up the lion's share of this cut, and it probably signifies to me that this experiment that has been followed since November 2014 has now been deemed a failure. I remember when it happened, I thought that's incredibly brave. But let's talk a little bit about why the Saudis did this in 2014. It was at this period that supply data from the United States was smashing expectations through the park. And the Saudis had a choice. If they wanted to try and cut production in order to hold prices up above the $70 a barrel mark, if they did that and actually the price didn't move, then really OPEC have lost all of their power in one clean cut. So the fact that they didn't do that, they wanted an experiment for market forces, that was almost 2 years ago now, and it's been a failure. Yep, so Darren, it's Istanbul. Sorry, it is Istanbul. So the informal meeting in Istanbul, I read that as October the 8th. Anthony, can you check that?
The actual Vienna OPEC
Yeah.
official meeting is in 30th of November.
So let's get these dates right. There's an informal OPEC meeting in Istanbul, and that is October the 8th to the 13th. October. I've got October.
30th of November is the official.
Yes, yeah, I know that.
I didn't think there was one.
All right, well, going by CNBC and the BBC, they are saying there's one in October the 8th. So let's go with that for now. There's an informal meeting coming up in October the 8th in Istanbul, so let's see what traction is gained from that. So that's starting just this Saturday. Of course, the official meeting is in November, and that's when they're going to actually implement what has been decided. But this one coming up on Saturday will be exactly how are they, going to follow on from that Algiers meeting. So that will be interesting. So watch this space. But it means that certainly until Monday, I wouldn't get in the trend of this oil move higher. Until we actually have any more news at all, the global oil market has changed. If they're giving up their free market approach to supply control, then you should imagine oil to trend higher. Where can it go? Well, this is where they announced, if you look at this big red circle, this is where they announced a move to the free market approach. And some analysts are saying, therefore, if we're no longer going to have a free market approach to production, surely these levels need to be seen again. I think that's quite a long way off. And absolutely, you have to see these cuts be implemented first. Okay, guys, thank you very much. I'll pass back to Ant just to wrap up, and then we'll get on with the trading day. All quite quiet at the moment. And obviously, as Ant mentioned, tomorrow non-farm payrolls being the big one to look out for. Thank you.
Yep, so thanks, Will. Just to clarify, I've just put in the chat. So the OPEC, non-OPEC oil producers plan informal meeting, Istanbul, Will's right, 8th to the 13th of October. The official meeting in Vienna to announce the details of which they'll be discussing in Istanbul will be an event Vienna on the 30th of November.